Thank you for joining us for Wealth Building Secrets for Real Estate Investors. This is a brief recap of a webinar on 3 walls of defense against the IRS, plus renovating, buy, and hold investment properties. The Wealth Building CPA. Aberi Okoye is a CPA, an active real estate investor, and founder of Wealth Building CPA. She owns real estate investments in 5 states across the Eastern Coast. Her company has helped over 5,000 people like you prepare their taxes online and offline. Her greatest joy comes from helping clients, friends, and associates become free of financial stress. Reach her at 1-888-502-3767 or online at www.wealthbuildingcpa.com or via email at info@wealthbuildingcpa.com. Our special guest is TJ Bencho, the co-owner of Aurora Real Estate Investment Services, which is a family-owned and operated business in Pittsburgh. They provide hands-off real estate investment opportunities for you. They have built a proven system that takes all the guesswork out of real estate investing. The Ultimate Wealth Building Plan. Stage 1 focus, Financial Needs Analysis Questionnaire. Stage 2 focus, Tax Planning and Preparation. Stage 3 focus, Entity Structuring and Formation. Stage 4 focus, Business Registration and Bookkeeping Setup. Stage 5 focus, Business Analysis Meetings. Stage 6 focus, Investment Property Purchasing. Stage 7 focus, Retirement Planning. Stage 8 focus, Year-End Tax Planning. For more information, please visit www.wealthbuildingcpa.com/theultimatewealthbuildingplan.html after this presentation. The Wealth Building Program is a 12-month training program that takes you step by step through the steps required to run a successful and efficient real estate business. Aberi and her team have developed this system after years of working with business owners and real estate investors on how to best use their professional skills, passion, and experience to pursue their entrepreneurial dreams. This program focuses on a specific element of the wealth building system: tax planning, tax preparation, entity structuring, business meetings, etc. At the end of the 12 months, you'll be in a position to operate a successful real estate business. Stage 2 focus, Tax Planning and Preparation. During this stage, your tax returns for the last 3 years will be reviewed for accuracies, inconsistencies, audit flags, and potentially overlooked deductions. We will also prepare individual and business tax returns for the current tax year. IRS Audit Prevention. There are many ways to reduce your chances of being audited by the IRS. The IRS has red flags for certain industries and tax filing behavior. Unfortunately, real estate investors and business owners stand a far greater chance of being audited than their salaried counterparts. We will look at some tips on how you can avoid these red flags. Try not to use whole numbers on your return, such as $15,000. This can look suspicious and raise a red flag. Always file the exact amount spent. Avoid using a Schedule C for your business. This is a huge red flag because business owners can hide income and claim personal expenses as business expenses. If you file as a partnership or S corporation, you will reduce your chances of being audited considerably. Partnership tax returns are the least audited type of tax return. LLCs are usually taxed as partnerships and are a great option as they also offer limited liability and flow-through taxation. Home office deductions can raise suspicion, but this can be avoided by filing a partnership or corporate tax return instead of using Schedule C. Ensure that your return numbers match the 1099s you receive from your broker, employer, etc. For example, if your 1099 from the broker shows $26,987 in proceeds from stock sales, the proceeds on your Schedule D of your tax return should be $26,987. Deductions that exceed your business income, even in a startup year, raise a red flag. Common mistakes. Mistake number 1, selecting the wrong business type for your business. There are some basic rules when it comes to selecting the right business type for your business. Don't put appreciating assets inside a corporation. There are a few, very few, instances where you might need to use a corporation to hold assets like real estate, but for the most part, don't do it. Mistake number 2, selecting the wrong NAICS code for your business. The IRS will compare your selected NAICS code with other businesses with the same code. If your business is being compared with a different type, you will look off, and that's a bad thing when it comes to the IRS. Mistake number 3, failing to elect to amortize your startup costs. You get a choice with startup costs: amortize them over 15 years, or taking an election to expense up to $10,000 in cost in the first year, but you have to make the election on your return. Mistake number 4, not selecting the correct accounting methods. There are 3 types of accounting methods: cash, accrual, and hybrid. It's amazing how many get this one wrong. Mistake number 5, not taking the full amount of loss in the startup year, or, for that matter, any growth year. It's easy to get lulled into a trap of, I don't owe taxes, so I don't need to look for deductions. The problem is that when the business starts being profitable, you've lost out on possible carry-forward losses. And if it's not profitable and you have to shut it down, you've lost out on possible losses. Mistake number 6, not reporting inventory for a retail business. This is a huge red flag for a retail business. If you sell stuff, you can't take an immediate deduction for inventory you buy. Inventory is an asset, not a deduction. When you sell it, it moves from asset to cost of goods. Mistake number 7, making a mistake with your salary. There are 2 things you can do wrong. 1, pay yourself a salary when you're in a structure like an LLC or LP. 2, not pay yourself a salary when you're in a structure like an S corporation. Mistake number 8, not setting up an audit defense. There are 5 things a good CPA will do to prevent an audit. Avoid red flag triggers on the initial filing. Be overachievers when it comes to disclosures. Keep overall reporting consistent as far as line items, unless obviously wrong. Coach our clients on what to keep, how long, and why. Proactively react to any IRS inquiry or audit notice. In today's audit climate, it's not just about audit defense, it's about audit survival. Tips for automatic pre-audit preparation. Receipts. If you don't have a receipt, don't claim the deduction. If you can't find a receipt, try to obtain a copy from the company who sold you the item. Credit card statements are dubious proof because many don't itemize what you bought. Bills. Like credit card statements, canceled checks don't prove anything except that you paid for something. If you pay a business-related bill by check, the important item to file is the invoice, along with the canceled check, if possible. Mileage logbook. If you use your car for business, track all your business mileage. Keep a logbook in your car and use it at the beginning and end of every client visit and office supply run. Record the date, starting and ending mileage, and the client name or other business purpose. Appointment book. You will need to keep your appointment book as a record of your business meetings, conferences you attended, and other business-related tasks you did. The book will confirm your receipts and mileage and, in the event of a loss, helps you prove that your business is legitimate and real. Check stubs and invoices. Keep a copy of every invoice you send a client and the check stub that goes with that invoice. Account statements. If possible, use separate bank accounts for your business. File all account statements, both business and personal. Commingling will just create a headache for you as you try to make sense of countless personal and business transactions. Aurora Real Estate Investment Services. Aurora Real Estate Investment Services understands that real estate is the way to build long-term wealth. We also know that your time is limited. We can help you locate the undervalued property, perform a cash flow analysis, determine the cost of renovation, estimate the after-repair value, renovate the property, facilitate property management, list property if a flip. Renovating buy and hold investment properties. What we will cover: knowing your market, do's and don'ts for all neighborhood types, renovations based on the type of neighborhood. Knowing your market. Do market research. Know what your market requires and take your property a step or 2 above. I use the labels such as A, B, C neighborhoods. A neighborhood, high-end rehab, primarily owner-occupied neighborhood. I usually only flip in this type of neighborhood. B neighborhood, a little less expensive rehab materials, 70% to 80% owner-occupied, flip and rent in this type of neighborhood. C neighborhood, rental-grade materials, still quality, but the right price to allow for the right return, 60% to 70% owner-occupied, primarily rent in this type of neighborhood. Do's and don'ts for all neighborhood types. Plumbing. Don't keep cast iron drain stacks. Do put PVC drain stacks in. Do install PEX plumbing. Don't keep old faucets, spouts, etc. Do put new faucets, spouts, etc. in. Electrical. Don't keep old wiring or service, be it interior or exterior. Do upgrade wiring and service, both interior and exterior, where needed. Hot water tanks and furnaces. Don't replace if not necessary. Do test if possible. Do put a new one in if you determine the current one has less than 2 years. Basements. Don't freak out if there is water. Do inspect to see if there is an easy remedy to the water. The roof. Don't replace if not necessary. Do repair instead of replacing if possible. Inspect the roof to decide if it needs to be replaced. Look at the condition of the shingles, whether they are curling, missing, or cracked and worn, and check for interior damage from roof leaks. Do replace or repair if any of the above is occurring. Exterior walls. Don't leave worn out and missing mortar from brick buildings. Do repoint missing and worn out mortar when necessary. Sandblast brick if it is painted and the paint is peeling. Do replace the siding if it is necessary for operation and renting of the house. Renovations based on type of neighborhood. Bathrooms. A neighborhood. Stone wall in the shower, slate for the flooring, and a high-end vanity. B neighborhood. High-grade tile for the tub surround, high-grade tile for the floor, and a high-grade stock vanity. C neighborhood. Ceramic tile tub surround if you're replacing, allure or ceramic tile flooring, a stock vanity if replacing. Kitchens. A neighborhood. Custom cabinets, ceramic tile backsplash, custom countertops, high-end appliances, and high-end fixtures. B neighborhood. High-grade stock cabinets, high-grade tile for the floor, stock countertops, medium-grade fixtures, medium-grade appliances. C neighborhood. Stock cabinets, allure flooring if replacing, stock countertops if replacing, and stock fixtures. Flooring and living areas. A neighborhood. Real hardwood floors and high-end carpet. B neighborhood. High-end laminate or medium-grade carpet. C neighborhood. Stock laminate, no carpet. Contact information. Aurora Real Estate Investment Services. Phone us at 412-498-2790 or email tjbencho@comcast.net or visit us online at www.investinpittsburgh.net. You can reach Aberi Okoye at 1-888-502-3767 or online at www.wealthbuildingcpa.com or via email at info@wealthbuildingcpa.com.